Thank you for joining us. We have a distinguished panel here today. Firstly, let me introduce Thea Jamieson, founder of Change Global Investment. I'm going to give each of the panel members a chance just to talk a little bit about their business themselves and the link to US investment more broadly. We have John Onwualu, former Managing Director of the Development Finance Corporation in the US. Welcome, John. And then we have Aziz Hassan Ali, Managing Director, Partner at Battle Capital. Welcome, Aziz. Thea, would you like to just say a little bit about yourself, Change, and your link to the US investment market, please?
Sure, John. Thank you for the introduction. My name is Thea Jamieson, and I'm the Managing Director at Change Global Investment. Change Global Investment is a specialist firm investing in public equities in emerging and frontier markets. We invest on behalf of institutional investors, primarily in the US, such as endowments, public plans, and foundations. I have over 20 years of direct investment experience in the developing world, having invested in well over 60 countries, traveled all over the world, opened several markets. So this is a very relevant topic for my work.
Super, thank you. John?
Thank you. Good morning, everybody, and thanks for coming out for the first session. I know it's pretty early. John Onwualu, I was former Managing Director of the Office of Equity Investments at the Development Finance Corporation. And for those of you that don't know what the DFC is, we were the former OPIC, Overseas Private Investment Corporation, and a couple of years ago we changed our name. But in general, we're the U.S. government's development bank, very similar to CDC here in UK or Proparco in France. Over the last year and a half, I worked to build out the direct equity team, direct private equity team at the DFC. We recently gained authority to take ownership stakes directly into companies, and I was working to build that up over the last year and a half, and just recently made the transition out.
Thank you, John. Aziz?
Morning, everyone, and thanks for the introduction, John. Battleair is a special situations private equity fund. We're headquartered in New York, have an office here in London, and we look at global investments. And because I grew up in Africa, I have a soft spot to try and invest in Africa. Our focus is on everything from hard asset investing, which would be in aviation, shipping, energy, and real estate, to other special situations. And thus far, since we started a few years ago, we've made several investments in Africa, everything from infrastructure to things in aviation and energy as well.
Thank you very much. I think from memory, the US makes up about half of the world's AUM in terms of investable assets. So, a small allocation is quite transformational for a market like Africa. I'd be interested, maybe we can start with you, Aziz, in terms of the current challenges for US investors looking at Africa. What are some of the key considerations and hurdles that the US investor has to overcome looking at Africa?
That's a really interesting question. I think I'm going to start with the most important that I look at today, and it's very topical, which is really the COVID challenge. And what I mean by that is, when you look at the vaccination rate in Africa versus anywhere else in the world, with about 4% of the population being vaccinated, it just makes it incredibly difficult to want and come and do business, like due diligence business or have meetings in Africa because you're petrified about going there. And I think that's going to be a stumbling block for the next 12 to 18 months until, you catch up on that curve. And it's disappointing because it obviously is going to just delay potential US investment in Africa. And then once you take out this COVID cloud, then you come back to the fundamental issues in my mind of what are what are some of the challenges of Africa and, dealing with Africa, being a US investment firm. And those are the typical things of opaqueness, corruption, regulatory, et cetera, et cetera. And then the real question is, how do you try and solve those issues when you're sitting and saying, I actually do want to invest in Africa, but I've got all of these challenges, but I see this great opportunity, and how do I balance the two together? And that, that really, I think, comes with potentially more government support in order to make sure that you can bridge that gap.
John, anything you'd like to add?
Yeah, I think that you said it incredibly well. I'd add in currency fluctuations and some of the macro factors that are difficult to control, especially for U.S. investors that are focused on a more stable regulatory environment with a currency they understand. That was one area at the DFC that we really tried to bring, confidence, credibility, and understanding of the specific regions where we would try and crowd in private capital to help mitigate some of these risks, or at least help better understand them. But hopefully that adds a little bit more perspective.
Aziz, you mentioned increasing government support in the US as a way to increase allocation to Africa. Maybe just before I move to Thea, with your DFC background, John, do you see greater allocation coming out of the US government towards Africa, and what is their appetite for increasing allocation?
Of course. I think broadly across the G7, right, there was a commitment for $80 billion of capital to flow to Africa over the next few years, which the DFC was a large part in. And even speaking internally, in the new administration, it's been a huge priority, a large focus, and I think that the trends are only going to continue and the momentum to continue. Very similar to yourself, I'm Nigerian, or half Nigerian by background, and have an affinity to the region myself, but can honestly say that from an investment landscape perspective, we've seen a lot of momentum there, and I think that the U.S. government looks to hopefully enable that and be a catalyst to it.
Okay.
But if I can just add something, John, it's one thing when you have these blockbuster numbers. So we're going to increase allocation to Africa by 15%, 50%, whatever the numbers are. But just throwing dollars at a pool is not really how you can then convince the private sector to actually invest, because you kind of need to be able to create those pathways where an individual or a firm like ours can actually go and get those dollars. And in a lot of instances, many institutions just make it incredibly difficult for the American investor to be able to benefit from those services or those funds. For example, maybe the committee will meet once every 6 months and only when there's a full moon. And so if the full moon doesn't show up, then you wait another 6 months, because that's what you've got to do in order to get it. And I think, both of those have to go hand in hand, right? It's great that you can throw a lot of dollars to and say, we're trying to do a lot in terms of investing in Africa, but then how do you actually get those dollars to the private institutions so they can actually invest? I think that's where there's a bit of a challenge.
So I think that's an interesting comment, and maybe I can link that to the endowments in the US, because I've always thought the endowments could play a much bigger role in the US market, and that they'd have much more of an affinity for Africa, and obviously a number of them do invest, but I would have thought there'd be a better fit over time with the endowment market. So Thea, maybe I can bring you in at this point. In terms of your interactions with endowments, do you have any? And then I think another challenge, maybe a second question for you, is the dollar has been so strong, and the US markets, the S&P has been so strong when you try to convince the US market to invest in Africa. Are those challenges that you have in terms of marketing Africa to the US institutional market?
Yeah, so absolutely. On the public side, we do have slightly different challenges, simply because our benchmark is the S&P. That's what asset allocators look at as a reference point. And so I would say that there are 2 or 3 ongoing challenges. Currency risk has been one really since the global financial crisis. We have seen a very strong preference for dollar-denominated assets, and that has resulted in significant pressure on the African currencies. U.S. institutional investors have U.S. dollar-based liabilities, and that is very important to them. I think that the sentiment has changed a little bit, at least on the margin, since the new administration came into power in the U.S. in November of last year. At least the investor perception is that there will be more trade, which should be better for capital flows, and therefore the outlook for domestic currency may have improved on the margin. Now, some of the sell-side research houses do provide their macroeconomic outlook, and based on that, the currencies seem to be rather attractive. So we're starting to argue that not only are equities attractive on the public side, but also there could be potentially a tailwind from currency appreciation. Another risk that's very important and a hurdle that we face on the public side is the liquidity of the public markets. We saw liquidity improve in the 2012-2014 period as some of the mutual funds set up for investment in Africa. That has taken a step back, unfortunately, after we saw some of that hot money exit. But I think that since the pandemic, if anything, liquidity has started to pick up again as a result of domestic investors coming back to those markets. So I think that at least with those two key challenges that we've had over the past several years, there is some light at the end of the tunnel.
No, thank you. Two comments from myself, which I haven't heard much about actually yesterday. I think at a time when the world is very concerned about inflation, a lot of the African countries have a natural hedge because they're exporters in dollar-priced goods. So impact of global inflation might actually be fairly muted in Africa. And the second point is, I think there's, we're talking about currencies and the perception around currencies. African currencies broadly have been quite stable over the last 3 years. And most of the African countries are running big trade surpluses, which is positive for currency. So my personal view is that we're going into a more stable local currency environment. We talked a little bit about local currency and a lack of appetite for local currency. Aziz, maybe you can talk a little bit about the role that US investors can play on the ground in Africa, not necessarily about local currency funding, because I don't think there's any appetite for that. I presume your fund's a dollar-based fund. But again, a local currency would really support growth of local capital markets. But more broadly, the role that funds like yourselves can play in terms of development on the ground in Africa.
Yeah, I think from a local currency perspective, obviously any sort of investment is going to be needing to be converted into whatever the local currency is, and you're going to be able to bring substantial inflows as a result of that. But from the other side of that pendulum, you're absolutely right. There is a lot of stability in the currency today or the currencies today versus where they were 5 years ago. And it does give you a little bit more comfort, but it is still a significant risk factor. And, I think the only way for us US investors to get comfortable is by making sure that we can have hedge policies in place. And sometimes those are really costly, which again comes back to where you need the support from government agencies in order to balance that out and make it a little bit more, solvable.
Yeah.
Just to add on to that, and even related to your previous question, I think, at least from a U.S. perspective, when I speak to investors that are starting to look into the region, in a former life, I was at a SoftBank portfolio company doing corporate development and M&A, and we were looking at, regional players in Africa, Latin America, and Asia. And speaking of the momentum as well, 3 years ago, Africa was not on the table, right? And did a couple acquisitions in Latin America and Asia. And those same investors who we were speaking to a few years ago that were thinking about, Africa being off the table are now making some of their first investments in the region. And the thesis always being that a lot of the technology-focused businesses, at least from a currency perspective, could outgrow whatever the inflation or currency devaluation there might be. And I think that as we see that momentum happen more and more and have more successful outcomes, it's only going to continue and bring more capital from the US into the region, and especially when the investable landscape in the US is highly competitive.
So we're talking about challenges. I'm going to come on to opportunities because you started to touch on the fintech, for example. But maybe just before we get into the opportunities across Africa, Thea, I'd be interested in your views on whether US investors view Africa as a diversifier in terms of their investment opportunity set, and whether Africa really does offer diversification. Yeah.
Absolutely. I mean, on the public side, the African markets are increasingly more driven by local investors. And that means that those markets are driven by domestic news flow, domestic flows. And that's something that's incredibly appealing to US investors today, because they do see the global risks and headwinds, especially since the changes in the regulatory environment in China. We've seen increased interest. And I think it's for those reasons investors are looking to diversify away from some of those global developments. The currency risk could be also turned into a diversifier benefit, and that's what we're trying to bring up to the table. We have had actually a lot of resistance to hedging back to the dollar from our investors, because they do want to take on this idiosyncratic risk.
So I think that's still one of the most powerful arguments for African investing, is the low correlation with other markets, certainly on the public side. On the private side, I'd be interested, I think one of the challenges is lack of exits that go onto market. There are lots of trade sales, which public funds never get to see. And just returns in general across private equity in Africa have lagged, my sense, other markets. Is that a constraint for US investors?
Yeah, no, I think absolutely. Obviously liquidity when you're trying to exit anything is absolutely critical. And that usually becomes the biggest deterrent of investing in Africa, because it's great. You can go and throw a lot of money into buying a portfolio of supermarkets or whatever you want in whichever region. But then when you want to exit it and you've generated more EBITDA and you've made these changes into the business, there's no one there to buy it except a local entity who wants to give you a 20% discount to the value. So, and those are some of the concerns that you have, and it is difficult to rectify that, because the markets just have to mature more before you're going to have more liquidity, and you need more investors to come in from all over the world in order to get in there. But I think that with that comes opportunity as well, because the one thing that's very unique about investing in Africa is the ability to create a lot of cash flow during your investment period. And that's what sometimes investors don't fully appreciate. You get deterred because you say, I can't exit this thing. But in 5 years, you could hypothetically take out all your money plus something. And people don't really quite appreciate that there are those cash flow potentials, which obviously exist in other geographies as well. It's not only something special in Africa, but it is fairly unique because of the margins you can get in certain businesses. But I do want to come back to one thing
But sorry to interrupt you there. That hasn't always translated into returns for the funds, that generation of cash flow. So why is that, and relative to other markets?
I think it comes back to that exit, because when you all add it up together and you say, okay, I've generated a lot of cash flow in those 5 years, But when you're trying to then exit it at the end of 5 years, you get that local investor who gives you a 20% discount to your exit value. And I think that, there are probably more creative ways in which one needs to look at exiting. And again, as a US investor, if you are armed and get the support of, Prosper Africa and all the other governmental agencies, there are ways in which you can enhance or secure a better exit value. But it hasn't happened.
No.
You're absolutely right there. But I did want to come back to one thing about diversification. A lot of people do say it's great you can diversify in Africa, but John, you can diversify in a lot of different geographies around the world. And the question, I think, is how do you make the case more compelling for the investor to diversify in Africa? Because if you have $1 and you can choose between South America, Africa, or Asia, all three of those offer diversification opportunities, right? But there has to be something more compelling than saying, great, Africa is going to account for 1/4 of the world's population in 2050, or all those nice statistics to make it more compelling to say, put that dollar in Africa and don't put it in South America.
So maybe that's a good way to talk about the compelling opportunities in Africa. John, maybe you can talk a little bit about fintech specifically. I know you have a very interesting background in fintech. And then I know, Thea, maybe after that, you have a broad range of opportunities in some of your funds. What are you seeing in terms of opportunities across Africa at the moment? Some compelling ones to make it a more interesting investment market for US investors.
Of course, yeah. I think that the nexus, and coincidentally, I worked in fintech before this, has been a huge opportunity just given the underbanked and highly underpenetrated digital banking opportunity in Africa. You take Nigeria, for example, which has roughly 200 million people, 20 million plus just in Lagos alone, but only 40% of them are even online from a banking perspective whatsoever. And US investors, when they're searching for opportunities that have the ability to scale, right, underpenetrated markets like that are highly attractive, right? And it's not just necessarily the direct-to-consumer opportunities that, from a digital banking perspective, right? But it's the infrastructure that goes into it. It's banking as a service. I think yesterday Tiger just led another Series A of banking as a service platform, Mono, right? Seems like almost every week now that there's some infrastructure or vertically integrated play, whether it be payments or alike, that US investors are attracted to. And I think that a big part of it is that these business models have been established. There's precedent, operating models in the US that investors can understand. And something like financial technology, outside of the regulatory environment, it's a relatively similar business model, right? And I think that brings confidence to investors outside. And there are other sectors within technology as well, but hopefully that gives some perspective on financial technology specifically.
Yeah, I think taking proven technologies and models from, for example, the US into Africa, will give greater confidence. So I agree with that. And Thea, yesterday you talked about lots of different sectors and opportunities in your funds. What do you see as the most compelling opportunities?
So Africa on the public side is clearly on fire sale today. And really you can just pick and choose across the board by geography and sector. We have investments.
I think we said it was on a P of 7.
Yeah.
Forward P of 7.
And you could do even better than that in some markets. So we have on the west side, we have investments in Ghana and Nigeria and Cote d'Ivoire. On the east side, Kenya, Uganda. We have investments in all over the place. And so from a geographic perspective, I would say across the board, sub-Saharan Africa. In terms of a particular country focus, I think that we're paid to wait in Nigeria, so we're continuously adding to our exposure there. Tanzania is very, very interesting today. It has become one of our biggest investment destination. That is where we're finding stocks that are priced at 3-4 times PE. Tanzania recently went through a foreign ownership limitation relaxation, and that is helping liquidity a little bit, but it's also attracting attention of the global benchmarks. FTSE included Tanzania to its global index in November of last year. We anticipate that MSCI will follow in the coming months or years, and that could have a very significant impact on shedding more, bringing attention to that market. On the sector side, I would say that for us, the most interesting sector is the capital market development sector. So examples for that sector would be companies that are levered to the growth in the capital markets. There's interesting opportunities in Nigeria, in the insurance, in the asset management sector. And I think Aziz referenced the market dominance and the type of profit margins that one can extract in those type of industries. There's interesting opportunities in Kenya as well with the local stock exchange, which is traded. And so the theme there is that in the short term, we're seeing liquidity improve as a result of domestic investments and foreigners coming back. But in the long run, that dominance of US institutional dollars will diminish, and it's going to be, the domestic involvement would be much more important. So that's where we're seeing good ways to invest.
Okay, thank you. So just to go back to finish the compelling, needing to make it more compelling then for US investors, maybe you can talk a little bit about, you know, your fund, what you're doing, Aziz, and where your opportunities are. And if we can go from there into how do we mitigate some of the risks? And you know, let's talk a little bit about, is the risk return compelling for US investors? Yeah.
Yeah. So I think Bataleur is a bit more unique in the type of things that we invest in. So it's not the traditional private equity who's going in and buying, you know, a portfolio of coffee shops and, you know, pick your favorite country in Africa. So some of the things that we're involved in today, we're involved in the healthcare sector, distributing an alternative to a hand sanitizer. But, you know, that's actually case in point where we've been facing a tremendous amount of challenges in actually getting this to different, you know, whether it's government or other NGOs or even on the retail side, despite the fact that the vaccination rate in Africa is so low. So you're offering something that could be a significant advantage to the population during this limbo period or catch-up period with the rest of the world, but it's not being well received. So that's just one example of where, you know, something that we're involved in, we're very passionate about because we can see it'll actually deliver a lot of good value and make a strong impact, in addition to which, you know, it can potentially save a lot of lives, but it's being received with a different mindset. The other things that we're involved in are in aviation, where we are, you know, making some investments in assets which are on lease to certain airlines in the continent. We're also involved in the aviation sector with certain airlines in the continent. And then, you know, on the shipping side, we've been in discussions with certain governments to, you know, to participate in this port boom that's going on all over the continent. So those are some of the things that we're involved in on a day-to-day basis. And then, you know, another thing is on the energy side, and we've worked on a number of projects on energy in Africa as well.
Okay. It sounds like with a greater focus on, you know, impact investing as well, there's maybe an opportunity to increase appetite from the US market, possibly. But, you know, if I listen to the specific opportunities that you highlight and outline there, but maybe just going back to mitigating some of the risks in the market. John, maybe you can comment on, you know, how does one mitigate some of the risks for US investors? We haven't talked about credit risk, you know, but maybe you can comment more broadly.
Yeah, I'm happy to speak to some, and my role was specifically more private equity versus credit, so I can pass it to my colleagues. But in terms of mitigating risk, a lot of the stuff that we've focused on recently is understanding the regulatory environment, right? And trying to work with local regulators, local lawyers, councils, et cetera, to really understand the landscape and communicate that to partners. There's a couple funds that we're working with in particular on the continent, one of them being AfriCinvest, that has really dedicated a lot of focus to this, which I was impressed by, because understanding the different country regulatory environments, communicating that to outside investors, and actually bringing in U.S. investors, that a big hurdle, right? We've talked about currency, we've talked about credit risk now. Regulatory environment is one of those, right, where especially country to country can change drastically, and it's definitely different than the U.S. So not only understanding it, but then going above and beyond to actually work with people who are making these decisions in the specific countries and across the continent, I think could make a big difference. But I'll pass it to either of you guys as it relates to credit risk, if you have a perspective.
So that's not a fair question for you, Theo, because you're a public equities person. So I don't know if you want to add something on.
No, I'll actually add to that. I mean, and it does form a huge part of our analysis, is how do you mitigate that credit risk? And the ways that we found, again, it comes back to, it's interesting. It's not on the Africa side, right? But it's really on this side, meaning the US side, where you're trying to work with US agencies, US government agencies to perhaps get political risk insurance, other protections that you can try and get, even financing on certain projects, because if you were to try and look at the local markets to get financing, it's too costly. So I think the ways in which we typically look at mitigating risk are trying to find partnerships on the US side and trying to see, are there ways in which we can get insurance hedges, currency hedges, or otherwise in order to encourage us or entice us to actually make the investment in certain countries.
Okay, thank you. Maybe one area we haven't touched on so far, and then I'm going to open it up to questions. We've got 5 minutes. We talked a little bit yesterday about investors, certainly local investors and foreign investors, tending to invest in fixed income, probably as opposed to equities. It's a higher interest rate environment in Africa. We talked a little bit about inflation. Is that a deterrent for investors in Africa, the high interest rate environment currently?
So high real rates were a significant headwind up till about early last year because those yields were so attractive. But I think that there is a change coming into place. Yields have come down since the pandemic, and that is making equities more attractive. By our estimate, in 3/4 of the investable universe in Africa, dividend yields today are higher than fixed income instruments. And so I think, and we certainly see a change in the mood and direction there. And that could be incredibly powerful, especially in markets that have been out of favor with diminished cyclical liquidity. Think about the pension funds in Nigeria. Until the 2018-19 period, the domestic pension fund industry was 97% invested in fixed income. So even a small change on the margin into equities can have a very significant impact on liquidity as well as prices in those markets.
So maybe that's a good place just to pause and see if there are any questions. But I think the point that Theo made about the growth of local pension funds is significant in Africa. It's going to dampen a lot of volatility, and having local investors on board as well, I think will give a lot of confidence to foreign investors coming into the market. And that has been a sea change. Certainly 10 years ago, there were no local pension funds. So, I think that's a significant development. So we've got 4 people here who have high conviction in Africa, who've given you a good case around some of the opportunities. I'm going to just open it up and see if there are any questions for any of us. Any comments from anybody on the floor?
Yes.
Yes, Christopher, and there's a microphone coming.
My name's Christopher Hartland-Peel. Institutional investment into Africa. One of the things which I've been doing for the last 30 years is running a database on African companies and markets. But looking at the last 2 to 3 years, what has been very significant has been listed companies on non-African exchanges whose businesses are predominantly in Africa. So if you look at Airtel Africa, if you look at MTN, even though it's a Johannesburg-based company, it is actually more activity in Sub-Saharan Africa, ex-South Africa. Have a look at Helios Towers. Have a look at the up-and-coming IHS tower listing in the United States. Your thoughts on that, please, for institutional investment in Africa, and why you need to go to an African exchange.
So I think that once those listings move outside of Africa, I'm not a big advocate of that move. I feel that it's counterproductive to developing the local markets. To some investors, it may be more appealing because the shares may be denominated in pounds or Canadian dollars, but does that really help develop the local markets? I'm not so sure. So we would look at all of those opportunities, but our preference where we see the bigger structural hurdles presenting the pricing opportunity is in the local markets.
So I think just to add to that, first prize is to have African companies listed on African exchanges because the capital markets just aren't developing fast enough. I think private credit is going to provide a lot of capital market opportunities on unlisted, but maybe listing these companies on foreign exchanges as a transitory period, and hopefully over time we can get these companies listed on African exchanges. Certainly, I think it gives regulatory confidence, maybe provides more liquidity with the type of investors that are coming into these companies on big global exchanges. But yeah, it's not first prize, but we'd rather have them than not at all. Yeah. Any other questions? We've got time for one more question or comment. Great. Well, thank you very much. Thank you to the 3 of you. That was very interesting, very helpful. And thank you for sharing your views so early in the morning. Thank you to all of you for being here for the early session. Yeah.
Thank you, Joe.